The Individual Investor Show.
You want it all, don't you? They share one thing, they all need money. Now let's see if they're brave enough to earn it.
Hello and welcome to the Individual Investor Show. My name is Jennifer Shearer, your host for this afternoon. Thanks again for tuning in. I hope you all had a wonderful week. So during a volatile bear market, people are utilizing stock screens as well as dividend investing strategies to bolster their portfolios. A recent study conducted by Alliance Life stated that 40% of investors say they're too nervous to get into the markets right now. But that's because many individuals lack the education, tools, and resources to navigate through the ebbs and flows. That's why at AAII, we aim to help individuals learn how to best utilize stock screens and other strategies to find the right investments for their portfolios. Tonight's event is the Individual Investor Show, Sizzling Stock Opportunities. For this episode, Dividend Investing editor Derek Hageman chats with us about his latest First Cut Stocks articles in the June 2022 issue of the AAII Journal. The articles present the current high-yielding dividend payers and the current largest rising dividend stocks. He explains the differences between the two and how to judge whether a high yield or rising dividend payment can be sustained. And in the second part of this episode, we sit down with assistant financial analyst Matt Markowski to discuss his latest article, How to Best Use Stock Screens to Build a Portfolio. In his article, he shows investors how to choose a predefined stock screen or build your own to effectively find the opportunities that fit your individual and stock investing needs. But before we jump in, I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus cannot give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. So without further ado, sit back, relax, and enjoy our presentation. Hi, Derek. Thanks so much for chatting with me today about your two articles in the June 2022 issue of the AAII Journal, High Yielding Dividend Payers and Up and Away, Biggest Rising Dividend Payers. Awesome. I just wanted to jump right in. And thank you again so much for sitting down with me today. And so my first question is, can you give us a high-level overview of the two main dividend investing strategies, high yield and high dividend growth?
Definitely. And thanks before getting started. Just thanks for having me today. You know, I love to talk about dividend investing strategy. So happy to join the conversation. So your first question, there are two main dividend investing strategies, high yield and high dividend growth. And as you think of these two strategies, it may help you to think of a continuum with high yield on one end and high dividend growth on the other end. And in the middle, there are different blends of these two strategies. So in general, we can say that the high yield strategy, as the name implies, seeks high yielding stocks. And due to the higher than average yield, the market often perceives these stocks as riskier compared to high dividend growth stocks. The high yield signals higher risk and may indicate weaker growth prospects, whereas the high dividend growth strategy, again, as the name implies, seeks growing dividends. The market perceives dividend growth stocks as less risky due to better growth prospects. Dividend growth stocks have a lower absolute yield when compared to the high yield approach.
And, during market volatility, like what we are experiencing right now, what makes these strategies a good portfolio protector?
Yeah, so I mean, companies whose cash flows have translated into rising payouts, they're known as dividend growers. And the high dividend growth strategy seeks financially strong companies that are healthy enough to sustain and even grow their dividend. So these are companies that have competitive advantages that will allow them to continue to earn above average profits and sustain their dividends for years. And one of the competitive advantages is that these stocks typically have some pricing power. So they are leaders in their industry and they can pass price increases along to customers. And really what it comes down to is dividends that can grow faster than inflation are a good portfolio protector.
Interesting. And, as investors, how can, they know when to, or how to pick the right strategy that works for them? Is there one that helps to achieve a certain goals or specifically better for a specific type of investor?
Well, the high yield versus high dividend growth debate, it definitely raises an important question. Yeah, which are the better dividend paying stocks? Stocks with a lower initial yield, but with a higher dividend growth rate, or stocks with a lower dividend growth rate, but with a higher initial yield. So that's the growth versus high yield. And really nothing brings out a dividend investor's passion like a lively debate over the better dividend strategy. There are investors that invest in both high yield and high dividend growth strategies, but there are others that definitely prefer one style over the other. So we'll let you decide which strategy works best for your specific situation and financial goals. But for our purposes, what we're really trying to do is to make you aware of each strategy's benefits and challenges. And that's what we're hoping to do by answering some of these questions.
That makes sense. And, in your article, you do mention, you mentioned that there are 3 types of high yielding stocks. And so I wanted to ask you, if you could expand on that a little bit, and then also what qualities do they specifically possess?
Sure. So like you said, there are 3 types of high yielding stocks. One, there are high quality dividend growth companies, which are temporarily mispriced and on sale. These probably aren't true high yielders, but sometimes during bear markets or periods of extreme volatility, you might find a high quality company trading at a depressed level so that its current yield may be 1% to 2% higher than its historical yield. 2, there's structural high yielding stocks. So for this type of high yielding stock, we think of a real estate investment trust or a REIT or a master limited partnership, which is also known as an MLP, where due to tax regulations, the company is required to distribute 90% of its income to shareholders or unit holders, as they're called, in the form of cash dividends or distributions. And the third category is struggling companies with temporary high yields. The high yields here may be temporary, not because the stock price is about to rebound at any moment, but rather because the company is likely to either cut or eliminate its dividends. The market may often misprice equities, but the market is also right an awful lot of the time. And it's important to keep an eye on unusually high yields, as they can be a signal that the payout may not be sustainable. So if you're going to be a long-term dividend investor, dividend safety is paramount. And if you're going to be a high yield dividend investor, it helps to seek quality companies from either of the first 2 categories. Sadly, there won't be many quality companies in the third category. There will only be unrealistic and unsustainable promises.
Interesting. And, when you're compiling this, your first cut list, how did you find and filter out the 15 high yielding companies that actually made the first cut for the month? What did you specifically look for?
Yeah, so I mean, this month's first cut shows 15 high yielding companies. And the first cut universe, it was limited to exchange listed stocks with a share price above $3, and foreign stocks were excluded because of some of the uniquenesses of their financial statements. And so we included a filter requiring annual dividend increases over the last 3 years. That period was specified. The 3-year historical dividend growth rates, they provide a sense of dividend sustainability. We also looked for positive current earnings for the current fiscal year. Was also required as a minor financial strength screen. And we also looked for the current dividend yield to be greater than 4%, in order to be superior to the current 30-year Treasury rate. At the time of the article, it was 3.23%. So those are the couple of the filters we looked at to generate the list of high yielders.
And so, how can you judge whether a high yield or rising dividend payment can be sustained by a company? I know you touched on in your article. I just wanted to ask you about that.
Yeah, sure. So when investing in dividend yielders, your investment criteria should consider more than just the yield. In order to determine if a company continued to pay out a high dividend yield, make sure you focus on stocks of companies that are financially healthy enough to sustain and even grow their dividend. So there's little point in seeking out dividend paying stocks unless the dividend is secure and expected to grow. Many companies pay dividends, but those companies that can really sustain their dividend payments are more desirable. Dividends tend to be sticky. So once a dividend payment is established, companies are under tremendous pressure to maintain and increase the payment. And a company's stock price will likely be punished in the event of a dividend decrease or suspension. So there are many measures that investors use to help assess the safety and sustainability of the dividend, but the payout ratio is perhaps the most common calculation. And just as a reminder, the payout ratio is calculated by dividing the annual dividends per share by annual earnings per share. And the payout ratio helps an investor determine if earnings are sufficient enough to cover the dividend payment. So companies that do not pay a dividend have a payout ratio of 0, and they really retain all their earnings. A firm that pays out half of its earnings to shareholders with a dividend has a payout ratio of 50%, while a company with a dividend equal to its earnings has a payout ratio of 100%. So just to add a little more, a company's payout ratio is often compared to sector and industry medians, as well as against its own historical average. So companies in defensive industries like utilities, they tend to have stable and predictable earnings and cash flows, allowing them to support higher dividend payout ratios than cyclical companies, for example, whose earnings may fluctuate significantly quarter to quarter. There's often no hard rule for the earnings payout ratio. It is merely a calculation that can be used as a tool to determine the safety of the dividend payment. And one last thing, a payout ratio over 100% is generally regarded as unsustainable, since a company can't pay out more than 100% of its profit through dividends in the long term. Generally speaking, a payout ratio below the historical average is more attractive because it illustrates that a company has grown earnings faster than dividend payments and potentially has room to grow its dividend, since payout earnings used earnings per share in the calculation, they can be volatile.
Oh, that's really interesting. That's really good for investors to know, so that they can plan. They can look at that that historical data, like you said, and see if it is actually sustainable or if it's unrealistic. Like if at that 100% payout. And then I wanted to ask how can investors make sure a high yielding dividend stock is a quality company and not one with weak growth prospects? You kind of mentioned a little bit about sustainability, but I just wanted to ask you about this as well.
Yeah, sure. So like I mentioned earlier, to make sure a high yielding dividend stock is a quality company and not one with weak growth prospects, we can look at some of the filters we used for the first cut screen. So again, the importance of a filter requiring annual dividend increases over the last 3 years was specified. So we're looking for trends where the company continues to increase its dividend over time. That's really important. And we also looked at the 3-year historical dividend growth rates, and that provides a sense of dividend sustainability, which again is very important. There's nothing better than the trend of a company. And then we also looked at positive current earnings for the current fiscal year was also required. And this was used as a minor financial strength screen. So we looked at dividend sustainability through the increase of the dividend over time. And then we looked at a couple financial strength screens as well.
And lastly, I just wanted to ask you, how investors can best use stock screens that we have at with AAII, and also AAII's dividend investing service, to build their own strong portfolio to find these high yielding dividend stocks or other companies.
Sure. So I'll just focus on the dividend investing strategy. It seeks higher than market yields and dividend growth at a reasonable price. So therefore, the dividend investing approach, it would really be categorized as a hybrid strategy. We were thinking about the continuum earlier. So it would really be a hybrid strategy, but it would lie closer to the high dividend growth end of the spectrum. And to achieve a total return that consists of both dividend income and capital appreciation, that's really what we're trying to accomplish with the AAII dividend investing focus. And in order to help us achieve that, we do look at 3 pillars when making dividend investing decisions. The first is we look at growth trends. So we look at a company's record of growth in revenue, earnings, and cash flow. We analyze those three things. We also look at profit margins, earnings surprises and estimates, and we look at the dividend history and dividend growth trends. And really, it comes down to a company's success is driven by its ability to generate sales and convert that revenue into earnings and cash flow. The second thing we look at, one of the three pillars, is financial strength and quality. We look at a company's leverage ratios, we look at cash flows, we look at payout ratios, which we talked about earlier. We look at the earnings payout ratio, and we look at the cash flow payout ratio. And we also look at capital return to shareholders through dividends and share buybacks. And these items are monitored to ensure that a company can continue raising its dividends. And the third thing we look at, the third pillar we look at, is valuation. Stock prices tend to fluctuate between high and low extreme valuation levels. And these relationships can be used to determine a stock's value range. And the two main valuation metrics we examine are dividend yield and trailing price earnings ratio. So hopefully that helps to give you an idea of how to accomplish not only dividend growth, but stock price appreciation as well.
No, it really does. It does. And I'm glad that we were able to go through your two articles, because I definitely learned a lot. And I know our members will also learn a lot about, how to pick and how to use, AAI's dividend investing, to their advantage. So that's great to know. But yeah, thank you so much for chatting with me, Derek. I just wanted to remind members that they can read the latest issue of the AAII Journal and Derek's two articles by visiting AAII.com/journal. But yeah, thank you so much. And I hope you have a great rest of your day.
You're welcome. Thanks for having me. Have a great day.
Thanks. Hi, Matt. Thanks so much for making time to discuss your latest article in the June 2022 issue of the AAII Journal, How to Best Use Stock Screens to Build a Portfolio. Matt is one of our newest members on our team of financial analysts and also lead editor of the Stock Superstars Report. So thank you, Matt, for taking time. I really appreciate that we're able to talk about your articles today.
Yeah, no problem.
And so my first question is, can you give us a high-level overview of what a stock screen is and how can investors use them at AAII?
Sure. So a stock screen is a tool that investors use to sift through thousands of publicly traded companies to identify stocks with a common set of characteristics. Running a screen is an excellent starting point for building a portfolio based on a specific investment strategy. We develop screens based on fundamental characteristics of companies to see if they fit the mold of our chosen investment strategy. Another way to think of a stock screen is as a database filter. We use our Stock Investor Pro research database program to analyze the fundamentals of thousands of publicly traded US-based companies. These screens are all quantitatively based, meaning they rely on numerical data within a specified range. Creating screens is an immensely powerful tool when looking to develop an investment portfolio.
Excellent. And, in your article, you mentioned a common misconception about stock screens being a way to create almost a buy list based on certain criteria. So can you just explain this misconception a little further?
Yeah, so when you run a screen, it can return many stocks or few, depending on how strict our underlying criteria is. However, all the stocks on that list are not necessarily viable investments. You must go one step further and determine if that company aligns with your investment goals or your strategy. Also, it's important to go over company financials to make sure they have common qualities of financial strength to keep growing, or they're continuing to make profits.
And, what are the main benefits of using stock screens to find potential investment opportunities?
So I think there are two main benefits of using a stock screen. One is to make selecting stocks much easier among thousands of possible investments. The other is to stick to an investment strategy and reduce all emotion involved in decision-making. Becoming attached or investing off your emotion, it reduces our capacity to make educated decisions. A stock screen will use that fundamental data that I talked about to change our approach to investing.
Makes sense. And, so I wanted to ask you, can you explain the different types of stock screens that we have at AAI, and then also what are their purposes?
Yeah, so there's two main types of screens that we offer AAII. One is factor-based, and one is what we like to call our guru stock screens. Factor-based screens use fundamental characteristics of popular investment strategies to find stocks. Some examples of this are value, momentum, growth-based strategies. We're looking for criteria that follow these strategies closely. On the other hand, our guru screens are slightly different in that they follow the investment strategies of famous investors over the years. These investors develop some of the best winning strategies that we can emulate in our screens for fundamental company data.
Excellent. And what are the key steps? You mentioned some in your article, and I just wanted to ask you how to best use stock screens to your advantage. So can you give us a little background on this?
Yeah. So the first step in either developing or following any of our stock screens is to lay out your personal objectives. Maybe you want to follow smaller companies for potential of rapid growth, or you want established companies that pay dividends and provide income over the long term. Asking yourself these questions will help you define what criteria to look for in any screen. We can then refine our criteria or your criteria to be highly selective or more broad. The goal is to find stocks that closely align with your initial objectives. This will create a perfect starting point for building a portfolio.
And so I also want to ask you, what common mistakes can investors avoid when using stock screens?
Well, one mistake that is easy to make is having screening criteria that is contradictory. An example that I gave in the article is combining high earnings growth with high dividend yield. Companies that are in a rapid growth phase typically need cash to expand their business, and they can't afford to pay dividends. So when you combine this criteria, it negates the objective of the screen. It leaves you with a list of stocks that don't really fit a strategy, if any stocks will pass at all. Another mistake is to have criteria that's either too selective or you just have too much criteria in your stock screen. An overly restrictive screen will return fewer candidates for you to consider for your portfolio.
That makes sense. So it's really good for investors to know. And how can investors, we talk about pre-built versus, ones that you can create your own. So how can investors actually decide if they should use the pre-built ones on our website or go ahead and create their own with their own criteria?
Yeah. So as I said before, our fundamental rule of thumb is to first lay out your initial objectives for your investment strategy. If you find that one of our pre-built screens follows your objectives, it would be smart to follow that screen rather than reinvent the wheel. All of our pre-built stock screens have been back-tested over years of data to prove that they're built for higher returns. If you have objectives that don't align with our screens, you can pick primary criteria for companies that will follow your investment goals. And some of this criteria is followed in some of our pre-built screens. So I would say that using pre-built screens is a good starting point, but if you find it doesn't follow your objectives, you can go further and create your own.
That makes sense. And, this is kind of a follow-up, but are there specific things investors should be aware of if they decide to create their own? I know you said that, what they can avoid, but is there anything that they should, include?
So first you need to select primary criteria for a screen, and you should decide on whether you wish to compare the data on an absolute or a relative basis. Relative conditions compare company's current financial situation to either a historical level or to, the market sector or industry benchmarks. Whereas absolute conditions are a set level that criteria must meet to pass the screen. Certain criteria must be used on relative basis. For example, industry price to sales ratios are usually compared on an industry level or a sector level. But besides the point, after you select primary criteria, you should develop secondary, or what we like to call qualifying criteria, to filter the stocks that are worth looking at and the ones that aren't. This could be as simple as looking for stocks that are priced over $1. This helps us avoid smaller volatile companies or penny stocks that could be bad investments.
Excellent, excellent. And in your article, you do mention that there's a useful rule of thumb is to sell a stock when it no longer reflects the spirit of the strategy used to identify it. So can you expand on this a little bit?
So I think of it as common sense. If we use screens to invest based on our outlined investment strategy, it makes sense to sell these holdings when they no longer reflect that strategy. So you can modify the initial criteria used for stocks that pass a screen to develop rules for deleting stocks from a portfolio. This reinforces our ability to make educated decisions on the sell side, much like our educated decisions when we add companies that pass the screens initially. The strategy of altering screen criteria for decision-making is employed by all of AAII's model portfolios, since it allows for making decisions based on clearly defined objectives and quantitative rules instead of emotion or intuition. You do not want to let emotions trigger your sell decisions.
And is there anything AAII specifically recommends investors do when using stock screens? I know you mentioned a little bit ahead, before, but if there's anything else you wanted to add?
Yeah, so even though a stock screen specifically looks for quantitative aspects of a company, it's important to consider those qualitative aspects as well. This is why we urge you to conduct further research into a company rather than just selecting any stocks from a screen that pass a screen. Pay attention to a company's current economic position, how their management is running things, or their overall business model. This type of research will filter the passing companies list into the excellent investments that we're looking for.
And so, how can investors, after, listening to, our talk, and reading the article, how can investors find the right stock screen for them?
Well, if you want to find the right screen for you, you should take 2 or 3 of the criteria, the initial screening criteria that align best with your own outline strategy to develop long-term rules for managing a portfolio. Then you can compare your objectives to the screens that use the criteria you wish to follow. This will maximize your efforts in finding companies that compare to your own strategy.
That's good advice. And, lastly, I just wanted to ask you, if an investor is just getting started using stock screens, where would you recommend they start on the AAII website? And kind of as a follow-up, what resources would you steer them towards?
Yeah, so all our pre-built stock screens are located on the screening tab from the homepage of our website. From there, you can find both the factor-based screens and the guru screens that I discussed earlier. If you wish to create your own stock screens, A+ Investor offers the custom stock screener. Also, our Stock Investor Pro program offers more customization for stock screens and the ability to run them. But I think a good thing to start, or a good place to start, is just go to our screening tab and take a look at our pre-built stock screens, because you may find that one really speaks to you and works with your own investment timeline and your investment goals.
Excellent. Excellent. Well, thank you so much for chatting with me, Matt. I really appreciate it. And I just wanted to remind members that they can read the latest issue, including this article of the AAII Journal, by visiting aaii.com/journal. So yeah, thank you so much, Matt. And I hope you have a great rest of your day.
Yeah, thanks, Jenna. Hope you do too.
We hope you enjoyed tonight's broadcast. I want to thank Derek Hageman and Matt Markowski for making time to chat with me today about their articles. If you're looking for more information on stock screening, we have an online community that is available to all AAII members, where hundreds of people are discussing topics about screening strategies, what stocks are on their watch list, and how to best utilize AAII products, as well as so much more. Visit community.aaii.com to learn more and join the stock screening community. And as always, please remember to click the subscribe button if you'd like to be alerted of future II shows. You can always catch a replay of tonight's event by visiting our YouTube channel. And make sure to register for upcoming events by visiting AAII.com/webinars. And if you're an investor on the go and want to catch the II show while driving or going for your daily walk, you can now find us on Spotify, Apple Podcasts, iHeartRadio, and so many more. Also, members can read both Derek and Matt's articles in the June issue of the AAII Journal by visiting AAII.com/journal. And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and happy investing.